What's going on, everybody? Welcome back to the first Multifamily Minute episode here on the Multifamily Hour. First episode here on the newly rebranded show, the newly rebranded podcast. If you're like, what is he talking about? What's going on? What happened to the Multifamily Wealth podcast? Go and listen to the last episode that I uploaded to the feed where I share why, after 5+ years, really 6+ years of running the show, running what was formerly known as the Multifamily Wealth Podcast, I decided to rebrand the podcast. I get into in that episode, so I'm not going to cover it again here. But in case you missed the last one, same show, same content. We're going to keep it tactical. It's purely multifamily. Nothing's changing on that front. But what I'm going to start calling these quick solo episodes, that's what I used to call them. We'll be rebranding those just quickly here for the purposes of introducing these episodes to the Multifamily Minute, where I get into a very specific topic and try to keep it tactical in 10 to 20 minute spurts here on these episodes. But without further ado, let's get into the topic of this Multifamily Minute episode, which is going to be a little bit of a deep dive into the concept of the K-shaped economy that is permeating throughout really the US economic landscape and how that impacts real estate investors and how they should think about approaching deal making right now, both as it relates to the deals they should be pursuing and then actually the business plans that they implement on those deals. So before we get into that, let's talk about what I mean when I say K-shaped economy. So K-shaped economy it's basically a way to describe an economic landscape of which the folks who are the kind of call it the bottom line in the K shape there, which is used to represent kind of the lower middle class, struggles in the economy, right? Where we have wage suppression, we have cost of living increases, rents, home prices, groceries, et cetera, start to become more expensive. However, wages aren't growing at a commensurate rate, and the lower to middle class segment of the economy feels a squeeze and starts to feel pretty tight in regards to, free cash after paying living expenses. Whereas the top, part of the K, where we're starting to increase on a graph, so to speak, which is used to represent the, call it upper class, upper middle class, experiences the opposite effect, where there's a growing sense of affluence amongst that dynamic or amongst that segment of the economy, I should say, and where there's more spending on luxuries, there's more spending on, or I should say, more discretionary spending, more spending on housing, shelter, etc. And usually this is driven by a dynamic in the divergence of asset ownership. Lower middle class owning fewer assets, whether that's real estate, whether that's stocks, whatever it might be, businesses, right? There's not obviously significantly less business ownership. Whereas on the other side, the upper middle class are benefiting from rising asset prices, whether that's real estate, whether that's the stock market, whether that's business valuations, et cetera. And that is oftentimes by much smarter folks than me, much smarter economists than me. I'm just the guy reading these articles. This is how they're describing the economy that the US is experiencing right now, where you have folks at the top doing very well, folks at the bottom doing less well, right? Let's just simplify it down to that level. But it's interesting when you start to look at the economic landscape through this lens and you start to look at all of the different sectors of the economy and you start to think about kind of the shrinking middle, right? The shrinking middle class has been discussed forever in US politics, US economic discussions. But right now, basically post 2020, it's taking on a life of its own in that the monetary injection of post COVID monetary policy completely fueled this dynamic to a level that's never been seen before, where all of this money that was introduced into the economy fueled asset prices and continued to increase this dynamic, right? Cost of housing increasing, rents increasing, along with inflation, has had a dynamic that has shrunk the middle class to a level that, frankly, hasn't been seen for a very long time, right? I'm not going to assign a date to it, but for a long time. So, a lot of the businesses that quote unquote served the middle are struggling. And some examples of this that you probably see out there, right? Average gyms, right? The local gym in your town or the average chain gym where the membership prices were quote unquote in the middle are struggling. And gyms that sit on either end of the spectrum, from a pricing standpoint are doing well. Planet Fitness being on the lower end cost, lower end side of the spectrum, Equinox being on the ultra high end side of the spectrum, right? Equinox can just keep pushing their monthly membership pricing, three, five, $700 a month, depending on what you get for that membership. And because their customer is typically the top end of that K-shaped economy, the upper quote unquote upper middle class or upper class consumer, they have far more pricing power with how they can price their memberships. Whereas Planet Fitness is going, we're going ultra low end, ultra high volume, and that's the lane that they're living in. Restaurants are a good example of this. If you're either going to go to an ultra high end steakhouse, and I'm just speaking in binaries here to illustrate a point, but like the ultra high end restaurants are doing well because they're serving a high end consumer that's less price conscious. The restaurants in the middle are kind of struggling, like a lot of just the average chain restaurants. And then you have the high end fast casual restaurants that are doing really well, where you're walking in there, you're not paying for sit down service, you're not tipping, but you're getting a quality fast casual meal. Like those restaurants are typically where people are going to. It's either you're picking one end of the spectrum and that's where and that's where you're existing. Same thing with, very broadly speaking, experiences like the middle tier country club memberships or concert price, or just generally speaking from, vacations. Like those are typically struggling right now if you look at this data, right? It's cruises, ultra, low cost cruises doing really well, ultra high cost four-star resorts that are catering to that high-end consumer doing well. Whereas those who are trying to serve the middle are struggling. Like this is a dynamic that's permeating throughout the economy. And in like the info product space, this is just one that I'm adjacent to, just, knowing other real estate folks, just having experience, just knowing a lot of folks that live in this space. Like you do really well by selling the $10, $20, $50 entry level course on a topic, or you sell the ultra high end membership for $10,000 a year where you're holding the hand of the person that you're serving as your customer who is less price conscious. Trying to sit in the middle there, you're oftentimes getting crushed. So that's a long way of explaining a K-shaped economy in terms of how it actually permeates throughout the economy. Now let's talk about how that relates to real estate. So from a tactical standpoint, what does this mean for real estate investors who are trying to do deals and trying to put together business plans for the deals that they're buying? For us, that means on one end, right, the Planet Fitness, the, call it low cost, fast casual restaurant experience, the cruise vacation dynamic is competing on price. Are you going to compete on price? And if you're going to compete on price, you better do a great job competing on price. So, for example, what this means is buying a C-class deal where you're buying it at a compelling basis. Maybe you're renovating units and, improving the building. But to do so, it's life safety, functionality, basic curb appeal. That's the extent of where your reno dollars are being spent versus trying to overspend to capture some higher, some higher income earning tenant. The other way to put this is where you're trying to aggressively take a C-class deal up into a B-class resident base, right? Or to serve a B-class resident. Whether that's the location of the C-class building or whether it's like some of the intrinsic physical properties of it, that is a much harder business plan to sell right now than it was a few years back because there's just not as many of those tenants. And we see this in our property management company right now. It's like, you used to be able to serve kind of the top end of the C-class resident base or the bottom of the B-class by taking a C-class building that's older and kind of a so-so area and throwing in dishwashers and washer dryer hookups and really, driving that property into from an amenity standpoint where it could serve that B-class tenant. But then you need to obviously price the rent on that unit at a level to where you can justify spending those dollars. And that is a much harder bet to make right now. So what we've been doing in our business is understanding that for those C-class deals, we would just rather compete on price. I would rather not be the highest rent in the submarket or trying to set a new rent comp because I threw in a dishwasher and I threw in nicer LVP and I threw in granite. So for us, it's like we're doing very functional renovations and pricing these units at a number that is not the highest in the market. And we have far more interest as a result. And the tactical example of this is, in one city that we own real estate in right now, like in 2020, 2021, even in 22, and then even in the years before 2020, we were able to take a one bedroom unit, throw a dishwasher in there, use slightly nicer finishes, maybe do a tiled shower, and we would be able to list that at 1575, 1600 versus, maybe at the 1500 mark if we just had kind of those functional renos. And that trade-off made sense, right? The incremental dollars that we generated on the rental side made sense when we're spending when we're spending 20 grand on a reno instead of 15, right? It all made sense. Now, that's a much harder trade to make or a much harder sell, right? Oftentimes now what we're doing is when we get into that unit, we could add a dishwasher, we could do these different things, but we're less confident we're going to get that 1550, 1600 number on the unit. And we're probably going to absorb more vacancy than we previously have to get that number. And it's frankly just it's a riskier business plan to implement. So we're not doing that anymore, right? We're just doing the functional renos that make it a clean, attractive place to live, but we're not adding the washer dryer hookups, the granite. We're going to do a laminate counter. We're not going to do a dishwasher. We're just going to, throw cabinets back in and we're going to list at 1475. And we're going to get way more applications. We're going to get way more demand and we're going to lease that up faster. And the incremental bump is not worth it anymore for those types of deals, right? A C-class deal. Now, on the other end of the spectrum, if you're serving, call it the A class tenant base, like you have far more pricing power than you previously had, right? If you look at a major city, like let's just say a city like Boston, where I personally live, like the ultra high end buildings in the seaport of Boston or downtown Boston, they can keep pushing rent increases on renewal. And these buildings, like, it's still an amenity race. It's like the buildings that has the pool and has the, slightly bigger gym where that gym might replace the need for that tenant to go get a separate gym membership and to where they can just go downstairs and they work out at a nice big gym. Like they have pricing power right now and they can still push 3 to 5% increases on renewal because they're dealing with a very, or a much less price sensitive consumer that's driven by what am I getting? And if I get a little bit more convenience or a little bit more amenities, I'm willing to pay some much bigger number. And that's the example, or that the version that's the Equinox example. That's the upscale steakhouse that charges $100 for a steak, but they provide such a nice ambiance and the food's great and the service is killer that their net margin on that food is much higher than the net margin on the low end of the spectrum that's doing higher volume. So the example of this in real estate is like if you're buying the building in a truly A location, even if the building itself is rougher, like you should go all out on your renos. If you're buying the building that's right downtown, where the that immediate neighborhood submarket is occupied by folks who are making 250K plus a year, some very large, some large number, 300K plus a year, whatever that is in your market, that really wants to live in that area, that really wants nice amenities, and they're not going to be incredibly price conscious as it relates to getting what they want, then you should try to deliver what they want, right? You should not be competing on price there. You should be competing on what you're able to offer. So the example of that is you buy the building in downtown, wherever, great location. Maybe you've got parking too. Like you've got all these intrinsic properties with the property or intrinsic aspects of the property that are valuable to the end, resident. You should be going nuts and doing the entire tiled bathroom. You should be doing the high-end vanity. You should be doing the quartz countertops with the over-the-range microwave, with the dishwasher, with the garbage disposal, with recessed lighting, with nice flooring, where you have, obviously, this goes without being said, but like the in-unit washer dryer hookups, where you have smart tech on the doors, where maybe there's stuff even above and beyond that you're doing. You're doing like a built-in desk, like in a little corner of the unit. And then you're going all out on the amenities. Maybe you're taking a portion of that lobby and you're doing the package lockers. You're doing, you're framing in the storage units downstairs in the parking area or like in the basement or something like that. This is where it makes sense to do a ton of exterior work. You make that entryway extremely inviting and nice, and you buy that nicer exterior door than just kind of the off the rack Home Depot one. Because if you do all of these things, you can price to the higher end of the market, and you can be much more competitive on your pricing. And the example of this that's in real estate but not in long-term rentals or multifamily, but it's adjacent is like the Airbnb space or the short-term rental space. Like the short-term rentals that do really well are the ones, again, K-shaped. You're either going to compete on price or you're going to be ultra high end. You don't want to be stuck in the middle where you have some amenities, but you're trying to price at a level that competes with one or the other. Like knowing your consumer here is critical. You either should have that absolutely killer beach house that's right on the water with every amenity in the book, the outdoor shower, the electric vehicle charger, the golf simulator, the hot tub, all of that stuff. You should either have everything and then price at the ultra top of the market because that the person who's going to rent that space is not making decisions based on price, or you go the other way, right? You get a, just again for lack of a just to make a point, you get the shittier place that, sleeps a ton of people, doesn't have a ton of amenities, it looks average on the inside, but you're priced in the bottom 10%. And yeah, your consumer there is going to be like the larger group that's traveling in a pack that's trying to save on dollars, but that's where you're going to compete. You don't want to be in the middle with a decently renovated place, but doesn't quite have all the amenities, but you have to price it a little bit higher than the bottom end because you kind of needed to because you paid a little too much and you spent too much money on the renos, and it's not really like on the beach. It's like 3 streets away. It's like an 8-minute walk to the beach. Like you want to be one or the other, right? That's how you succeed today. And that's just an example, that example ties into the one I'm talking about from a long-term rental standpoint, where if you're going to buy the property in the A class area, you better do an A plus class reno and not a B class reno, right? Where it's like, and the mental approach to this is, oh, well, I'm gonna do the dishwasher, I'm gonna do all that stuff, but I'm gonna be like a little less expensive than all the other really nice places, up and down the street. Because that's not serving who's gonna live there. The person who's gonna live in that area wants to spend the most amount of money for the nicest place because they're not going to be sensitive to what they're spending. So act like that when you compose your business plan. Hopefully, this was a helpful episode. I think this was one where it's an abstract concept that I tried to turn into a tactical concept as it relates to how you can actually implement that in your business. And the part of this that I didn't really talk about, that now that I'm jumping back into it after I started ending the show here, is what you do if you're a B class investor, which is what so many people were and so many people still are. You know, I think if you're a B class investor who's buying like an 80s, 90s deal in a decent area, that you need to lean into not trying to leave the B class kind of submarket. You don't want to try to take a B class up into an A because the A resident doesn't want to live in the B class area or in the B class building. But what you want to do is you want to try to live in as close to the middle as you possibly can and put yourself in a position where you can pull up, you can pull some of these C class folks up into the B class by giving them a dishwasher, a little bit of extra parking, and a washer dryer in the unit. But you still want to price competitively based on the other units. You don't want to be the one who's over improving the B class building right now. Like that's not going to be a great strategy. And frankly, I think right now, like you're better off trying to pick one of the other two lanes to really live it at this point in the real estate cycle. And at this stage, in where we are economically speaking, 5 years ago, 6 years ago, that wasn't the case. Today, I think it is. Anyways, I hope you found this episode valuable. And if you did, please leave the show a rating and review. Or if you really want to be a valuable, cherished listener here, send this to somebody that you know, whether it's texting it to them, emailing it to them, what have you, if you're going to think they're going to learn something from this episode. But thank you all for listening and appreciate you. I guess, first of all, appreciate you guys listening. Second of all, I hope to keep a lot of you as we work through the show rebranded into the future. But thank you all for listening, and I'll catch you guys on the next episode.